Thanks, everyone. Really excited about this panel. So, tokenization. It's really moved on from theory to traction. Now we're going to talk about how it's going to scale. Really, we've seen treasuries, money market funds, being the sort of first use cases and examples of where blockchain can really improve how assets are issued, settled, and traded. From a Coinbase vantage point, though, the next phase depends on infrastructure. We're a firm believer in that. For tokenization to scale, we need issuers and investors to have a secure place, regulated place, and then also interoperable rails which they can trust. And that's the foundation of what we're building. So today we'll look at what's working, what we need to unblock, and what needs to evolve to make this tokenization mainstream. Before I delve into it, I'd love for everyone to give a bit of an update on terms of just their role, their firm. Maybe not Scott from JP Morgan. I think we know what their firm does. But yeah, if you could just start with Paul, maybe.
Yeah, so I'm Paul Adrien, co-founder and CEO of Spyco. Fintech company based in Europe. We launched the first regulated tokenized money market funds a year ago. Now the largest player in terms of AUM in Europe, north of $500 million.
Thanks, James. Yeah, I'm Scott. I work for JP Morgan, which is an American bank. I sit in our markets business and look at how we deploy blockchain across sort of private, public, and crypto, and how that fits into our existing markets business footprint from a trading side.
Hi, my name is Luke. I'm the CEO of Deribit, and for the ones that don't know us, Deribit is the biggest crypto options platform globally, and we just got acquired by Coinbase, which transaction closed 1-2 months ago. So this is still relatively fresh. 2/3 of our business is options, 1/3 is perpetuals, and a little bit of spot. The reason I'm being included in this panel would be collateral. So everything that's tokenized, the issuers would like to use as collateral on platforms like ours.
Hey everyone, my name is Guy Young, founder of Athena Labs. We're the third largest dollar issuer within the space behind Tether and Circle. In the last 2 years since we came to market with our product, we've grown from around 0 to $17 billion in total assets, and yeah, glad to be here.
Perfect. Let's get started then. So I think we're going to start with Scott. From a JP Morgan's perspective, what use cases are showing real adoption? Where are you seeing demand? And then also, how are you coping with that demand internally in terms of being able to sort of meet that demand through the various internal hurdles you might have to go through at JP Morgan?
Sure. Thanks. I guess it depends what you talk about from demand. So we've been working in this space for a little while, and we've got some products that have been out there for a little while, and they're interesting private permission blockchain type products that have some utility but aren't really a market solution. So there's value for us doing bilateral things around financing. We've got some real value to that from a liquidity standpoint. We've run some interesting start point use cases when it comes to short-term paper, specifically in the United States, but they're not market solutions. So from a demand perspective, actually, there's more supply than there is demand on that bit. What we're really starting to see, though, is demand for, I guess, exploring what capital markets could look like on public blockchain. And so if you've got the private stuff over here that's been happening for a while, and there's limitations to how far that can go. We can extend that boundary a little bit, but there's some limitations on that. Most of that's really around liquidity in the short end. Then you've got sort of the crypto world at the other end of the spectrum. In between that, there are a bunch of very well capitalized, sophisticated, and activist firms that have a real view on what capital markets, tokenized, if you want to call them that, assets might look like on public blockchain or across that spectrum. I think that's where we're starting to see a lot of demand from the market to really explore that. So it's not direct like, I want that asset, I need to have it. There are specific uses for that, and there are specific, I guess, examples of that in the market today. But I think a transformational change that we've seen is the appetite for that capital markets activity, both across debt and equity, to see what can happen in that space. And that will really drive, I think, longer term infrastructure. So we add some products to the market, we evolve those products, and then potentially that market infrastructure gets replaced. Like that, when we think about demand, like that's demand for change rather than demand for specific products. That's kind of where we're at. But that will narrow into specific product deliveries, and we'll execute some of those later this year and early next year to really sort of pressure test and sense where the market demand is on those things from an investor standpoint. And we expect to see a lot of it.
And the ability for you to sort of execute on that internally from a JP Morgan perspective?
Yeah, I mean, part of the reason we've been focused on the private permission stuff for the last few years is because it has been very, very challenging as a regulated institution to get anything done on the public side. Even if we felt there was an opportunity to explore public blockchain, there wasn't even really a lot of opportunity to express that opinion sort of more openly. And we're sort of running through a bit of wet concrete for a while to try and get stuff done. But I think now, there is a bit more of opportunity in the United States. The regulation and just the tone is different. And that allows us to have a bit more of an open dialogue around what our risk appetite is, what do clients want, how do we get over that threshold? And I think, at the most senior levels of the firm, that is the conversation. It's like, what can we do in this space? Where does our risk appetite extend to? And it certainly does include things like doing stuff on public blockchain. We've got JPMD on Base already. There'll be other products that we put on public blockchain.
Yeah.
Sorry?
Great news.
Yep. Yeah. So I think then that will grow, and we expect others on the asset side to grow as well. So those thresholds are as you would expect for any of the business. Like legal structure is fine, confidence in the product is fine. We get over this sort of regular technology testing, like all the normal stuff you would expect to run a business. Then there's a slight add-on still for sort of just risk appetite thresholds. And other than that, just getting on with business. So that's a real normalization of the conversation in the last probably 6 to 9 months.
So Paul, moving to Spyco. Now I was pleased to hear that Spyco is now the largest issuer of tokenized money funds. And that's a sort of a project that was very close to my heart many years ago. I was probably a bit too early on that front when I was at BlackRock. But what's really driving that institutional demand when it comes to that product?
Yeah, so I'll set aside demand in the Web3 industry for the sake of the discussion. We see unique demand from corporates specifically, and two types of corporates. Small corporates, first of all, because tokenization in our case helps us really improve access to money market funds and also the UX, the product experience that you have when subscribing and redeeming fund shares. The reason for that is because by sort of disintermediating the traditional issuance and custody stacks, we are able to offer a strictly better experience than if you go to your bank, open your brokerage account, and then use the brokerage account to move funds in and out of the MMF. So that's, there is really a big market there, by the way, because access to MMF is not a commodity at all in Europe, including in the UK, from my perspective. In the US, it's a very big asset class, it's a big retail segment, also startups, SMEs using MMF at scale. Not at all true in Europe at the moment. And this has been explaining most of our growth so far since we launched a year ago. And now increasingly we see also demand from mid-market and larger corporates because of the utility we are sort of uniquely able to unlock with tokenization of money market funds. And that comes, for instance, with liquidity, having a better accounting, several cutoffs per day, because MMF are still very much constrained from that perspective, and also collateral management, transferability of the fund shares from the trader's perspective mostly.
Okay. Guy, we saw some, I just want to sort of touch on, we saw some big moves on Friday in the market, and just USD in particular was in the media a lot. So I just wondered if you can give us an overview of like what happened, and from your perspective, it'd be great to hear that.
Yeah, for sure. I was on a flight from New York to London while the whole thing was going down with Wi-Fi coming in and out, so pretty painful flight experience. But yeah, I think the quick synopsis, and just to like attack it head on, there was extreme volatility, I'd say, around USD on a very specific exchange venue. What had happened here was a pretty interesting confluence of a few different things coming together. The way we sort of think about is a dollar asset keeping a peg is sort of, can you actually come to the primary issuance and actually redeem as much as you want at any moment in time? So I think that that's something that actually looks fundamentally different to what you'd call a normal DPEG, which is actually the issuer is telling you you cannot redeem this at par when you're coming to us. So during the market volatility, Athena had 0 downtime. We redeemed billions of dollars within hours for anyone that was coming directly to Athena. The issue that we had was actually a dislocation in the pricing on one exchange versus the pricing on-chain, which is where the deepest pools of liquidity sit, and then also where market makers can come and redeem directly from Athena. The reason for that was that the deposits withdrawals had actually been shut down on that exchange for quite a long period of time. And then also an Oracle implementation that looked quite different to the way that people implement oracles within DeFi. So most of the time when you're looking at oracles, you're trying to check some sort of average pricing from multiple different sources so that a single source cannot be manipulated to put out a price that doesn't make sense. One of the issues that we saw here was a single exchange just referencing its own order book for liquidation. So the price on the exchange could be 10% different to something that you're seeing externally, but there's no check to sort of check that that price is actually consistent with the market. So I think it was a learning experience for a bunch of us, but I think it was a pretty idiosyncratic event that you saw on a single exchange rather than a deeper issue with our redemptions. Yeah.
And you have other products as well, which are sort of more tokenized of real-world assets. So I don't know if you can sort of talk about how you see tokenization of collateral of real-world assets versus sort of synthetic tokens as well. How do you see the development of that? Can they sit side by side, or do you see one emerging over the other?
Yeah, for sure. So for everyone that doesn't know our core product, you can sort of think about it as a tokenized basis position where you're long spot on one side, short derivatives on the other, and you create what we call the synthetic dollar. The interesting quality or byproduct of that is that you're capturing a very interesting interest rate within crypto, which is known as a funding rate. So those interest rates tend to sort of average anywhere between 10 to 20% annualized on a very large asset base. So open interest within crypto is anywhere between 120 to 150 billion dollars in size. So there's only really like three entities or opportunities that are creating $10 billion plus cash flow opportunities in crypto. It's kind of Coinbase and Binance, and then Tether equity, and then the basis within the futures market. That's sort of the only thing that actually stands up at that scale. And so all we're trying to do there is actually tokenize that in a dollar format where you can then reuse it as collateral, whether it's trading derivatives, whether it's putting into DeFi applications, all these different pieces. And the view that we have is that it's not really my job to tell people how to sort of express their own risk preference. It's obviously a very different product to a normal stablecoin in terms of its both risk construction, but then also return profile as well. And the view that we have is that we just want to be a neutral issuer who can actually provide both products. So if you want to use a very plain vanilla stablecoin, which is a second product that we have called USDTB, that's basically just backed 100% with BlackRock's BUIDL fund. Athena or USDTB is the largest holder of BlackRock's money market fund at the moment. And the idea here is that you can express your own risk preference across both of these products, and we have them listed across a bunch of different exchanges where you can just decide which makes more sense for you as a collateral. Yeah.
Makes sense. Over to you, Luke, next. Just from a collateral perspective, as you mentioned with your hat on with Deribit, how do you think tokenization might change like collateral mobility when we see it today, or risk management, or sort of acceptability?
Yeah, so from our perspective, tokenization is a pretty complex story because I think there's 75 stablecoins at the moment. There's 100 projects coming up. All of them are keen to get listed on Deribit because without the proper use case, and I'm not saying Deribit is the only use case, but without a proper use case, it's essentially they're pointless because they're copycats of the rest. I'm based in Dubai. In Dubai alone, there's 6 or 7 dirham projects. There will be, 5, 10 Aussie projects, etc., etc. So all of them need a use case, and the use case would be exchanges as step one. Gets spot pairs listed, potentially. But perhaps even more importantly, use it as collateral. So all of them approach us, and they claim that their coin will change the world and it will garner billions of dollars of interest. Once that's done, like Athena, it can be pretty successful because it will attract a new audience, it will generate new yields. A synthetic dollar is different than let's say, money market funds, so there's a bunch of different stories, but there's not enough interest in the number of projects happening at the moment. So from our perspective, we care about liquidity, we care about risk management. So if we add a new coin, the first question is, would we add spot pairs? And we would typically say yes, because without the spot pair, we can't liquidate. So if you use Athena, BUIDL, or whatever the coin might be as collateral for your Bitcoin positions, once the market crashes, like Friday, you need to be able to convert the collateral into whatever coin you're actually looking for. Typically, in our case, it would be BTC. But secondly, creation redemptions, how is the plumbing done? How is the oracle, the index, who are the people behind it? So if I were to choose, I would list as little as possible because it only complicates the platform setup. However, we won't have that luxury, so there will be more and more. If you look at history, we started with stablecoins. That's the easy use case, of course. We added 3, 4, 5 others, like Athena, like BUIDL. We have Lido. So it's essentially all yield-generating coins. And the next question is, what will be next? So besides money market funds, will it be structured products? Will it be debts? Will it be equities? And how will we deal with that? So how will you deal with equities as collateral in your portfolio on a Sunday afternoon? It will all boil down to the same thing again. It will be liquidity concerns, and market makers need to guarantee certain sizes, etc. So it's a pretty complex story. But overall, I'm quite bullish on what's going to happen. Of course, many things will get tokenized, and we simply need to adopt and facilitate as much as possible.
And do you, I mean, obviously one of the debates is like public versus private blockchains and just, you know, the interoperability between the two, and will that enable more collateral mobility? What's your view on, you know, the survival of public blockchains versus, the survival of private blockchains versus public?
Yeah, it's a complex question. I think in the end, the system will perform at its best when capital can flow easily. So what you see now is that, for example, for BUIDL, we allow trading on Deribit for retail that does not meet the size criteria. So let's say you want to buy $100, you can, which typically you can't if you approach BUIDL directly. If you want to transfer that $100 out, you can't because you're whitelisted. Your address is not whitelisted, which causes like hurdles of usage. Preferably, all of that would not be there. However, with current KYC AML restraints, it's simply not feasible at this moment. But over time, I expect that those solutions will be made available, and that DEXs and SEXs and all kinds of platforms, capital can flow easily, which makes our life easier because there will be more market makers able to quote, there will be less plumbing issues, and liquidity will be at its best.
Yeah, no, that makes total sense. I think good moment now just to switch to like maybe what's holding us back, and we often hear like the regulatory landscape, it being unclear is certainly problematic. Scott, I just want to lean on you here and see, like, as a sort of large financial institution navigating this space, you know, how are you approaching the regulation, and just how do you look at it?
Yeah, I think there's still a lot of work to do there. I think it's been great that there's been some openness through, you know, the new administration in the United States. I think at least being able to have the debate is good, like figuring out where the right place for this to land in the overall market. What's the opportunity for capital markets, and how do we then get value out of it? I think is, at least now, it's a good conversation to have. But there are, you know, I'm going to sound like I'm short this stuff. I'm not. It's just there's a lot of hurdles to get over. So, you know, first of all, we're sort of been through the legislation. We need to get into rulemaking. That takes a while. You know, one of the key challenges for us is beyond the sort of what can we do. It's how do you then how does that get treated? If a Type 2A and Type 2B assets under the BCBS guidance, there's still 1,250% RWA. That's the original RWA acronym, risk-weighted assets, not real-world assets. That's expensive when it comes to capital, right? That's it's prohibitive when it comes to capital. And if you're a regulated entity that's got to subscribe to that particular capital treatment, it's prohibitive. So that needs work, and I think that will change. I had hoped it would change a little bit faster than it is, but I expect we'll see that. You know, if you'd asked me in April, I would have said by now. If you asked me now, I'd say sort of sometime in the first half of 26, and that's going to be important because that's when those rules are supposed to be implemented, and they've already been kicked by 6 months. That's kind of one bucket. There's other real nuances out there, like in different jurisdictions. If you sort of head into the bowels of some of the German regulation around like how you have to look after a specific asset and the tradability of that and the central depository versus like that's problematic. If you go to the United States and you think about the fact that crypto, particularly BTC, ETH, and a couple of others are labeled as commodities for bank-held broker-dealers outside the United States, that means you can't trade spot because of the Federal Reserve Act. So there's a bunch of different regulations that need addressing to really elevate the opportunity of what's ahead of us when it comes to not just crypto, but crypto-associated products.
And do you think regulators are just a bit scared about sort of opening this up?
Scared. Thoughtful, I think, is probably a better way to put it, and they should be. Because the great thing about this market is actually there's a moment in, sort of when you look back over history, this is the next kind of moment for capital markets to really think about how are they structured, is there an opportunity to extend that umbrella, the depth and breadth of like what capital markets are meant to do, which is really to enable growth in the real economy. So there's a big question out there that should be able to answer, but we do need to be thoughtful about that. And the reason we need to be thoughtful about that is because a bunch of people in this room, if you're on the buy side, you've got liquidity providers, eventually that's Mr. and Mrs. X who live in the middle England or middle America, and we don't want to lose their money. Like there's a real job to be done. Like that's important. And it's important because if we do get to a point where we move too fast, we're not thoughtful enough, and there's breakage, then the handbrake goes on and we lose the opportunity for a little while where we kind of rethink. And there's only a certain number of times that can happen. So measuring the right pace of openness and action, measured with some thoughtfulness about how to get there without sort of bringing too much risk into the market, I think is the right place. Does any regulator get that right? Probably not, because they're never going to keep everyone happy, but at least I think there is a debate to be had now, which is a positive step forward. But yeah, we'd like to see some areas that move faster.
Guy, maybe over to you. You're building sort of products on-chain and off-chain. And so, are those regulatory frameworks keeping pace with each other? Just how do you view the world from a regulatory landscape?
Yeah, I think we've got a dual track approach, which I think is quite similar to Tether actually, which is the USDTB, which I mentioned, is coming under Genius compliance in partnership with Anchorage around that product. So we're actually onshoring that product as a payment stablecoin within the US. And that's really just to target a slightly different user group, which is really aimed at sort of institutional use within the US. And then USD is not actually available directly from Athena within the US at the moment. It's more of an offshore product. And I think actually the learning that we had in terms of what I think Tether did quite well from a strategy perspective was actually recognizing that dollar issuance as a business is much more attractive outside of the US because legacy financial rails in the US are actually pretty good. You've got Venmo, you've got access to money market funds, you've got all of these different access points to get your hands on dollars. And really like a better business is actually built offshore. So it's a bit of a dual track sort of strategy that we have, yeah.
And then maybe Luke, over to you. What do you think is the biggest hurdle from a regulation perspective?
I think in the end, regulation is a massive hurdle for a global solution. So regulators typically fix stuff for their own area, which conflicts with, let's say, the neighboring area. Look at rewards for stablecoins. In some countries you can pay them, some countries you can't. Causes all kinds of operational complexities. And a citizen is easy, but what about the Cayman incorporated entity operated from, let's say, France? Would that be European, et cetera, et cetera? So all of that is pretty complex. But I think gradually we will get there. I don't think there will be 100 stablecoins. There will be a handful because this is way too complex to solve globally without proper scale. From our perspective, it's not really the regulatory hurdle. I think it's the adoption. So if you look at, let's say, money market funds, if you look at the holders of that, whatever, $1 trillion of assets, it's large institutions. Those are not the people that trade crypto today. If you look at who trades crypto and where those, let's say, the Athena assets are held by which type of entity, a lot of it is retail or early adopters of crypto. So before the actual conversion happens and the traditional firms start trading, I don't think the shift to billions of dollars in assets, as in institutional holders, will happen easily. So Of course, we need to fix the plumbing, but the users need to embrace it as well. And as you just mentioned, the traditional systems are pretty effective. Equities are highly effective in terms of tradability. Money market funds have like almost choice markets, so it's a pretty effective market without massive gaps. So for these people to shift to something which causes all kinds of operational complexities in their organization, plus regulatory hurdles, is pretty big hurdle for them to cross. So we will gradually get there, and of course, if you have one central solution or a few central solutions where all the assets are tokenized and you can use them as collateral efficiently, that's the end goal, but I think that's still pretty far away.
I think another difficulty, just to add on top of that, is that you've actually got a global product, and that's part of what makes it powerful, right? Which is anyone can get on the internet and buy $1 through a stablecoin. But you have global regulators who actually have a very different view in terms of how you actually treat and address them. So right now, there are actually extreme contradictions between MiCA and Genius within the US, where you can have a single token, but actually two regulators are telling you two completely different things in terms of what they deem to be acceptable. So at the moment, you either have to go like dual issuance structure or actually separate the token into two different products, which ultimately is actually a worse user experience because you're breaking liquidity, adding fees, all those different pieces as you sort of bifurcate liquidity beyond one asset. So, I think the right user-driven outcome here is that we actually have like a global consensus on what makes sense in terms of how to regulate these assets, because right now it's a global product with completely contradictory sort of views from a regulatory perspective. Yeah.
Makes sense.
Can I just weigh in on that for a second?
Yep.
I just don't think we're ever going to get there. Like, and that's like you look at the world's more Westphalian today than it has been for a long time. Like even inside Europe, across different national, so there's so much more national self-interest now than there has been for a while. And it comes down to it, like why? It's because they've got to raise money, and like tax is going to be it. So the tax version of how it gets run in one country versus another, protection levels, the political. We're just not going to get, I think, the idea that we're going to get to a point where the crypto market is completely global to the extent that people want it to be completely global is not going to happen. That's probably suboptimal when it comes to the product level, but I think it's a real perspective to take. So then when you think about your strategy, one should think about it in how do I have it for specific markets, and then how do I get the best optimization between those specific markets. Doesn't mean it's right, by the way. I just think that's where we're going to land.
And I agree with you. By the way.
And the second bit of that is like, actually, in a way, there are some upsides to that, because if everything's vanilla and it's all the same, there's no innovation, there's no change, there's no further development. To actually then, you've got to have a little bit of that competitive edge to drive some of that. So if you look at the upside, some of that means that, like, when MiCA drafters look at Genius Act next time and vice versa, like, there's another incentive to take it further and another incentive to innovate further. And some of that market dynamic, if we're looking for a silver lining, is helpful. But I agree, like, there's the idea of getting to that global product. I think generally we just need to get our arms around, like, that's not going to happen. And we need to get as close as we can.
Yeah, and I agree with you. I think what I was describing is more what I view as like a good user outcome.
Yeah,
but
yeah,
I don't think that's where we land. And I think with stablecoins in particular, they're kind of getting to the size now where they're becoming sort of geopolitically important at scale. Maybe we're not quite there now, but it's like a few $100 billion off of what that number looks like. I can just say in my own experience sort of operating and trying to do this within Europe, I do not think European governments want the growth of dollar stablecoins to exist at any scale within Europe. If you think about it, there's like two powerful forces here who are actually acting against their self-interest, which is every dollar that leaves a commercial bank to go into a stablecoin is actually negative for credit growth within the economy. And every dollar that leaves a euro to go into a dollar is obviously negative to the currency. So it's kind of like two of the most important things to most countries around the world, which is like, is my currency stable and is my banking system stable? Stablecoins are undermining both of these things through like permissionless access on the internet. I do think that this becomes like a bigger geopolitical issue in a few years when this starts to scale a bit bigger. So I actually understand why they disagree and aren't trying to proliferate the stuff. But it's exciting, I think, to be building in that space because I think it is starting to get to near global level of importance as sort of like an asset. Yeah.
You makes sense. Paul, we'd love to get your view as well. I think just,
Yeah, I mean, I think it's quite interesting because in our case, we decided to build, first of all, sort of local onshore regulated offering using the UCITS framework. The drawback is that it definitely slows you down in terms of go-to-market because you have all these regulatory obligations, etc. But the positive side of things, the advantages, let's say, is that you have a regulated offering You are able to work with regulated stablecoin issuers, for instance, with regulated fintechs and stuff. And the usage framework is quite interesting because you have a distribution passport across the EU. That said, we still have a few challenges from a regulatory perspective. In the EU, for instance, securities law is still national. So the way you issue a security in France is different from the way you issue it in Luxembourg. We decided to start from France because securities laws was very clear in terms of having a security, a native asset issued on the blockchain. I think Luxembourg law is very strong from that perspective, but there's a lot to do in terms of harmonization for tokenization to scale across Europe. And then if you take like EU and UK, for instance, there is still no clarity in terms of how you can passport an EU registered and EU-issued MMF to the UK and vice versa. So a lot of work to do on that perspective if we want to scale tokenization in Europe.
So if we look at future outlook and sort of think about what success might look like in 2026 and beyond, maybe Luke, I'll start with you. In your view, like what would you like to see or what do you think needs to happen in order for it to be a successful 2026?
Successful for me, that is. Or
Yeah, can be both ways, both ways.
As in, let's say that the topic of today, money market funds and those type of assets, for me personally, I don't think the use case needs to be expanded on derivatives. So we have choice, we simply need growth. So if we get systems, so looking at numbers, we have 60-ish billion in open interest. We have, let's say, 1/10 of that in assets, approximately 6-7 billion USD in assets. 2/3 of that would be BTC. So we're highly concentrated in BTC. The next one would be ETH, then a bit of Solana, etc. Money market funds, including stablecoins, is only a few hundred million. So for us, the focus is really on BTC, and we'll gradually get more attention to yield-bearing assets like USDC, like Athena. So success would be sizable growth in that area. I think success for tokenization would be, of course, some equities, etc. But I personally think structured products would be a massive opportunity. So all the stuff that takes a lot of, I can imagine that JP Morgan has hundreds or perhaps thousands of people entering numbers in some back office somewhere when barriers are hit and all of that stuff. I think if we can automate that in a proper way and do it tokenized, there's lots and lots of opportunity. And because those are just formulas, you can do a lot of stuff in terms of collateral, etc. Because you don't necessarily need liquidity providers. You don't need someone to determine what the value is because it's building blocks. So I think there's lots and lots of opportunity, but we're not there yet.
And what do you think is stopping that on a structured product side? Do you think stopping that sort of?
I think you open it up so that means that everyone can trade it, which means the client is no longer locked to UBS, JP Morgan, etc. So I think the banks would like to keep them in-house and platforms like us would like to make it global and become one platform that offers everything. So we have spot, we have options, we have futures, we have perpetuals, of course, other stuff like traditional equities would be interesting, structured products. We can truly become the everything exchange, but that also means that we will start competing with lots of people in the room. So whether that's the smartest move remains to be seen.
Watch this space, watch this space. Guy, same question to you.
Yeah, I think other fixed income, private credit type assets that are broadening beyond money market funds, which obviously made sense to start with as a simple product, I do think is interesting, and there is demand within crypto. But I think for me, it's kind of mixing crypto derivatives with assets that are non-crypto native, which I think is actually the biggest opportunity. So I think perpetual swaps on equities is kind of like the next $100 billion plus opportunity. And the reason I say that is that while Luke has dominated options within crypto, I think it's like 95% market share, whatever it is, crypto natives have shown a preference for perps, I think, on the retail side. A lot of institutional users obviously use options for hedging, but actually, if you're just trying to express, I want to be long X on leverage, I think people have sort of shown that perps is sort of the preferred instrument to do that within crypto. I think the very simple thesis here is that equities are like 33 times the size, just equities in the US, for like total crypto market capitalization. And I think that this instrument is something that retail institutions in the US haven't had access to on an underlying like an equity. And I think that that's, once perhaps become legal in the US, becomes a very interesting opportunity.
Paul, maybe?
Yeah, I mean, from my perspective, I think the next big moment for tokenized money market fund is seamless integration between stablecoins as tokenized e-money, electronic money, and tokenized money market funds. And I think what you can unlock by going into that direction is pretty massive. It's much more efficient settlement of subscriptions, redemptions. I mean, in our case, we process subscriptions, redemptions often via SWIFT in USD. I mean, it's clearly a pain, right, comparing to settling with USDC. So that's one thing, as a stablecoin as a payment instrument to buy and sell securities. And the other is also stablecoins potentially in the balance sheet of these products. If you can have stablecoins in the balance sheet of a money market fund, you can have potentially 24/7 redemptions up to the size of the stablecoins that you can have in the balance sheet. So yeah, integration in terms of flows and stocks, payments, balance sheets, I think is super interesting and can unlock quite a lot of value in the market.
Scott?
There's probably a couple of things. I would say, given we're in the UK, I'd like to see clarity and action out of the UK government around their strategy beyond where they landed the other day. So what does that mean? That means executing on the plan for Digit and really starting to invest in thinking about what the future UK market looks like. I think more broadly, building on the sort of consensus that's starting to happen with some of the agencies in the United States to get a clear line of sight on what the rulemaking will look like in the United States will be very, very good. That really does open the door to allow us to answer the question on what the broader capital markets could look like as the technology finds it's the right place within those capital markets to start. Going back to your first question, I think executing ourselves on some specific products to then really start to pressure test the demand of what that middle space looks like, capital markets on public blockchain, because I think crypto is evolving relatively well and it's a pretty mature set of characters in there. And notwithstanding some of the stuff that's on Friday, there'll be lessons out of that then develop the next phase and the next phase. I think that's fine, private, whatever, but that stuff in the middle will be interesting. But the most important thing for success, I think, in 2026, that all of that happens at a pace with the right risk appetite and the right risk thresholds, that we don't break the market or head into a sort of a crisis that's driven out of accelerated development that then loses the opportunity to take the next step. And I think managing the speed and execution in a way that we still really get innovation pulling the market along, but not in a way that means that we have another moment that causes us to stop, will be super important. And that's a challenge.
And a question probably to Luke and maybe a couple of others, we're coming up to time, but just, the winning model, how do you see that, who do you see providing that in terms of traditional finance institutions, crypto natives, combination of both? Like, how do you sort of see success being sort of delivered?
I'm slightly biased here, but I think the winning model will be Coinbase. But overall,
correct answer.
I think crypto native firms, innovators would be more equipped to actually get it done. So that the wishes might be comparable, but the actual execution power lies more with firms like us. We've proven that already. But in the end, I hope it will be partnerships and that we can do stuff together.
I think the most successful ones have kind of been people teaming up from TradFi and like within crypto and sort of leveraging unique distribution channels that exist on both sides and seeing how they can lean into that. So I think, what we did with BlackRock on the middle side, that sort of scaled from 0 to 2 billion in a few months when we put that into our product. And I think the pitch here is that we have good relationships with exchanges, with different DeFi applications and platforms that sit within crypto. We can take your asset, put it into a different form factor within the stablecoin, and then see how we can distribute it through our network. And so I think that that's actually the best outcomes here are usually someone within TradFi who has some sort of product, and then you're finding a distribution partner within crypto who can sort of help proliferate it further. Yeah.
Perfect. I think we're at time. So thank you all. Appreciate you coming along today and giving some great insights. Thank you all for listening. I think we've got our next panel coming up. Cheers.
Thanks, James.